Thanks for joining us. Today I'm talking to the CEO of Richard Murphy, who is the founder also of the Australian Corporate Bond Company. Thanks for joining us, Richard.
Thanks, Tom.
Now, why don't you just give us an update on XTBs since the platform launched?
Sure. So we started in May with 17 XTBs, all over fixed coupon bonds, and we grew that part of the business first, and then over the last 3 weeks, we've actually doubled the range. So it was 17, it's now 34. We've added some higher yielding bonds like Qantas XTBs, and then we've also added some floating rate XTBs as well as some fixed rate XTBs. So, and then some more fixed ones literally yesterday. So the range is growing, and we'll grow it again after Christmas. Kind of leave it over the Christmas period. And there's a lot of good education going on and talking to people about why they should have things like XTBs over corporate bonds in their portfolio.
Yeah, well, that's a good point that you're making in relation to the education side of things. So for people who aren't familiar with corporate bonds, explain the difference between fixed and floating.
Sure. Fixed, as the name suggests, is really the coupon is fixed. So when the bond is issued and it's going to be a 6% coupon, that's it. You put in your money and 6% every year until it matures, and that's it. Floating is, well, let's have a view on interest rates, or let's be worried about interest rates, perhaps. I'd rather my coupon floats up and down against a particular benchmark. So floating, as the name suggests, is the coupon isn't a fixed coupon. It floats with interest rates, basically. So there's a benchmark, and there's a margin above that, and it says, well, I'll always be that margin above that benchmark. So that's the core difference.
Okay, so how do you advise customers using XTBs when it comes to their investment portfolios?
Sure. Look, on one of the charts that we'll have a look at on the screen shows you really the differences between a lot of these investments. It starts with cash, which is absolutely stable, goes all the way down to equities, which is quite volatile, and there's everything in between. And you can see on that chart, a floating rate senior bond from a bank is not quite as stable as cash. It's not quite as straight line as cash, but the volatility is very, very low. And then fixed bonds are slightly more volatile. Hybrids are a lot more volatile, and equities quite volatile is what equity does. And then you kind of look at that in terms of your portfolio, and you think, well, I need some stability in my portfolio, so I need to really be thinking about, I've got some cash in a term deposit. Maybe I should have some of these bonds either floating, which is extremely stable, versus fixed, which is a bit more volatile, but not very volatile, as well as having equities and maybe some hybrids in there for income. But if you think about those in terms of which way they move, when equities fall, bonds don't fall, cash doesn't fall, they stay straight. They stay uncorrelated, if you like. So if you look at your portfolio, you think, well, if my equity falls, my bonds and my cash won't fall, so I've got some protection there in my portfolio. So really that's the message, is you need to be diversified in your portfolio. It can't be all equities and hybrids, because hybrids track equities up and down, basically, whereas bonds and cash don't, and they're more stable, whereas bonds deliver a better return than a TD. So returns on those bonds are 3 to 5%, the senior ones, whereas TDs are sort of 2 to 3 sort of levels. You get a bit more of a return for a bit more risk, obviously, because bonds are more risky than money sitting in a bank account. But it's not the same sort of risk you're taking with equities and hybrids, which are more volatile and obviously driven by what's happening in equities.
So obviously the main determinant of the products you're talking about is the level of interest rates. The US is going to probably raise interest rates in December. How's that affecting the outlook for your products?
Well, I think over the last 4 or 5 weeks, you've seen those yields drift up as the expectation for that rate rise increases, and the expectation in Australia of a rate cut decreases, better job numbers in Australia. And as a result of that, bonds that were trading maybe, let's say, at 3.5 4 or 5 weeks ago are now at about 3.7. If it was 4.2, it's now about 4.5. So they're kind of drifting up as that expectation of those two drivers is solidifying, and most people think it's about 100% now that the US will raise rates. So that's a good thing, to be able to differentiate between, well, there's cash in the bank at one level. Here is a group of investments in the middle that won't give you the outperformance of equities. They won't ever double or triple in value, but they will not go down as well. They're basically a loan to that corporate, and will they pay it back? If you believe yes, they will, then that's it. They're going to pay back the loan and pay you the interest. So that's why that stability. And if you look at that in terms of the next chart that we have, looks at over the last year, how have these different assets gone? So you see that the rough and tumble of equities, the roller coaster basically of equities. Has not been a great year for equities, and as a result of that, hybrids have been depressed as well. And then you look at those two lines, which are the fixed coupon bonds, and you see that's reasonably stable, but still amount of volatility, and then a very straight line of floating rate bonds, and both of those have beaten equities and hybrids because it's been a bad year for equities. That isn't going to continue forever. So if you look at that over 15 years, equities do perform the best. But over the last year and over the last year as well, if you'd looked at last year's numbers as well, there was a very strong case for bonds, be it fixed or floating. But really the case is really be diversified. That's the main case. Is you shouldn't really have all your eggs in one basket. Think about bonds mixed in with your equities and some income securities as well.
Richard, great insights. Thanks for your time.
Thanks, Tom.
And thanks for joining us today for the Executive Series.